Want to know what a likely Fed hold means for your wallet and portfolio? Here's how Kevin Warsh's first meeting could shape borrowing costs, savings yields, and market moves. Markets expect no change to the benchmark rate. That keeps the Fed in a wait-and-see mode as inflation cools unevenly and growth moderates. The 2% inflation goal still anchors every decision. Officials want clearer, sustained progress toward that target before moving. And because policy usually shifts in 25 basis point steps, the path and timing matter more than this single meeting. For borrowers, a hold keeps the prime rate broadly where it is. Many credit cards and home equity lines that float off prime would see little near-term change. Fixed-rate mortgages depend more on longer-term Treasury yields and inflation expectations. If incoming data hint at stickier inflation, mortgage rates can drift up even without a Fed move. If data cool, they can ease. For savers, deposit rates should stabilize near current levels. High-yield savings and short-term CDs may hover rather than climb. The trade-off is time versus flexibility. If you think cuts are further out, locking a CD could make sense. If you expect easing sooner, keeping cash liquid may pay. In stocks and bonds, the reaction hinges on data and the Fed's tone, not just the hold. Equities tend to favor a clear path. Cooling inflation without sharp growth damage supports valuations. Bonds key off the same reports. Softer inflation and labor prints usually help duration. Hotter data can push yields higher and pressure multiples. ETFs will transmit these crosscurrents quickly. Crypto, as a high beta asset, often tracks shifts in liquidity expectations and risk appetite around guidance. What's different this time is leadership and communication. A new chair can recalibrate how the Fed talks and how much interim volatility it tolerates. The statement and press briefing will signal how officials balance progress on inflation against growth risks. Holding now also extends the runway for more inflation and jobs data before any 25 basis point move. Emphasis on two-sided risks can nudge term premia and curve shape even without a rate change. Practical takeaway: check your variable rate debt and plan for stability, not relief, in the very near term. Keep cash ladders flexible. In portfolios, let upcoming CPI, PCE, and payrolls guide duration, equity exposure, and risk-on tilts rather than overreacting to the meeting day. Read the full article at finlitica.com.